Let's discuss financial risks in an interconnected world. Hello again, I'm Martin North, the Principal Analyst at Digital Finance Analytics. The Bank for International Settlements, the central banker's banker, has just released an interesting and concerning report with the catchy title of Financial Spillovers, Spillbacks, and the Scope for International Macroprudential Policy Coordination. I'll put a link to the complete report in the section below. But in its 53 pages of dry banker speak, there are some important facts which show just how much of the global financial system is now interconnected. They start by making the point that over the past 3 decades, and despite a slowdown coinciding with the global financial crisis in 2007-9, the degree of international financial integration has increased relentlessly. In fact, the rapid pace of financial globalization over the past decades has also been reflected in an over 6-fold increase in the external assets and liabilities of nations as a share of GDP, despite a marked slowdown in the growth of cross-border positions in the immediate aftermath of the GFC. This chart shows the evolution of advanced economies' financial exposures to a group of large middle-income countries, split into portfolio exposures and bank exposures. It shows that both types of exposures have increased substantially since the late 1990s. And here is another chart which again shows the linkages, looking at cross-border liabilities by counterparty. The chart shows the classification of cross-border debt liabilities by type of counterparty. It shows that cross-border liabilities, where both creditor and debitor are banks, are the largest of the 4 possible categories and increased rapidly in the run-up to the GFC. It also shows a rapid increase in credit flows relative to foreign direct investments and portfolio equity flows. They explain that cross-border bank-to-bank funding liabilities can be decomposed into 2 distinctive forms. Firstly, arm's length interbank funding that takes place between unrelated banks, and secondly, related intragroup funding that takes place in an internal capital market between a global parent and their foreign affiliates. They note that cross-border bank-to-bank liabilities have also played a major role in the expansion of domestic lending, at their peak in 2007, when flows accounted for more than 25% of all total private credit of the recipient economy. This also opens the door to potential arbitrage. For example, rebooking of loans, whereby loans are originated by subsidiaries but then booked on the balance sheet of the parent institution. Indeed, the presence of foreign branches of financial institutions that are not subject to host country regulation may undermine domestic macroprudential policies. This degree of global linkage raises significant issues, despite the argument trotted out by economists that there are benefits from the improved efficiency of resource allocation. First, the increased global interconnectedness has led to new risks associated with the amplification of shocks during turbulent times and the transmission of excess financial volatility through international capital flows. They suggest there is robust evidence that private capital flows have been a major conduit of global financial shocks across countries and have helped fuel domestic credit booms that have often ended in financial crises, especially in developing economies. Second, international capital flows have created macroeconomic policy challenges for advanced economies as well. For example, the rest of the world's appetite for US safe assets was an important factor behind the credit and asset price booms in the United States that fueled the subsequent financial crisis and created turmoil around the world. It is also well documented that since the GFC, the various forms of monetary policy pursued in the United States and the euro area have exerted significant spillover effects on other countries by influencing interest rates and credit conditions around the world, irrespective, at first sight, of the nature of the exchange rate regime. Finally, there is evidence to suggest that in recent years financial market volatility in some large middle-income countries has been transmitted back, and to a greater extent, to asset prices in advanced economies in other countries. For instance, the suspension of trading after the Chinese stock market drop on the 6th of January 2016 affected major asset markets all over the world. Thus, international spillovers have become a two-way street, with the potential to create financial instability in both directions. And this means that macroeconomic settings in the USA, and especially progressive rises in their benchmark rates, and the reversal of QE, will have flow-on effects which will resonate around the global financial system. In a way, no country is now an island. The paper does also make the point that there may be some benefits. For example, if the global economy is experiencing a recession, for instance, the coordinated adoption of an expansionary fiscal policy stance by a group of large countries may, through trade and financial spillovers, benefit all countries. The magnitude of this gain may actually increase with the degree to which countries are interconnected, the degree of business cycle synchronization, and the very magnitude of spillovers. But if maintaining financial stability is a key policy objective, the propagation of financial risks through volatile short-term capital flows also becomes a source of concern. Now, my own take on all this is that we have been sleepwalking into a scenario where large capital flows and international financial players operating cross-border can negate the effectiveness of local macroeconomic measures to their own ends. This new world is one where large global players end up with more power to influence outcomes than governments. So it's no wonder that they often march in step in terms of seeking outcomes which benefit the overall financial system machinery. Somewhere along the road, we've lost the plot, but unless radical changes are made, the genie can't be put back into the bottle, and this should concern us all. If you liked what you saw here today, please do like the post and leave a comment. If you've already subscribed, thanks, I really appreciate your support. And if you have not yet done so, please do subscribe to get alerts to new posts. I'm Martin North, the Principal of Digital Finance Analytics. Many thanks for watching, and I'll see you next time.